And Steve, I want to begin with you and talk to you about the importance of this 200-day moving average, where the S&P 500 just sits beautifully on it, retests it, and then bounces back away. Why has that become so important for this market?
I think it's psychologically important, Jonathan. You know, we've thought for a while this has been a correction looking for an explanation. And it's been one after another, a series of sort of lame excuses in our view. We've been waiting, I think the market's been waiting to get to this level. We saw the leaders finally come off last week, which to us is a sign of capitulation. We added to equities yesterday. We think the correction's over.
Chad?
So we've been overweight for the last 18 months. We, though, have been ratcheting down our risk exposure as credit spreads start to widen out. As high-frequency data points come in, they're a little softer than expectations. But at this point, we're in a low-return environment. And as you have the Federal Reserve raise interest rates and monetary policy start to readjust to more of a hawkish stance, it becomes a little bit more of a competitive asset class.
Steve, it seems to me that we're really struggling to explain massive moves that maybe don't have an explanation. I find it difficult to see why a conversation about trade justifies a 6% downside move on the S&P 500 last week. Equally, I also find it difficult to accept a couple of nice words from the Treasury Secretary means that we're warranting a 2-something% rebound in the S&P 500.
Well, that's not...
What's that all about?
That's not fair, Jonathan. I mean, we had a 6% correction or something last week on the back of the trade war. All you needed was some semblance of...
Just a little bit of whiff of hope?
Oh, yeah. Like these people are not completely crazy that you took some of that off. We've never thought a trade war is coming.
Chad?
It's not about the trade war. It's about the currencies between the dollar as well as the yuan and savings and investment within China.
Yeah.
That kind of capital flow is really what scotched the market.
What is clear, Steve, is that vol's back and vol's back in a big way. And what is also clear to me is that we're really struggling to shake off that volatility shock of a month ago. Whether you look at the VIX itself or the volatility of volatility, things really haven't calmed down in a significant way. Why not?
Well, volatility always goes up when the market corrects. So I actually would look at it as the correction first. It was long overdue. We had a massive year last year. The economy, is moving to a new phase here where the Fed's now in play. So you had a well overdone correction, and you had the double test last week. I would say our view with volatility, I don't know that it's going to get back to last year's levels, but volatility should start to calm down now.
Steve, what gives you the confidence outside of the technicals that the sell-off is done now, that we've shaken out this period of 1 month volatility? What gives you the confidence, the conviction that it's in, the low is in?
The fundamentals. They're so good. I mean, we just had in the last 2 weeks, we've had 5 economic indicators go to multi-year cycle highs, leading indicators. I think the economy is very good in the back half of the year here. For all the reasons you've been talking about on the show. We're now entering earnings season, starting next week. We know those numbers are going to be good. We expect them to actually beat. So the market's going to have something to focus on other than all this noise that we've had for the last 2 months, and it's going to be a good focus. The market is cheap. It's trading at 16 times earnings. We think it's going to go a lot higher. When you come through periods of volatility like this and you survive, another cadre of investors come into the market. There's a lot of restored skepticism, which we think is the wall of where you need to go higher.